All right. It looks like we have folks that are joining our webinar now. Welcome everyone to the next installment of our Money Matters virtual learning series. Today we're going to be focusing on investing for beginners. So this is going to be a great workshop if you've ever been curious about what it takes to invest in something, what the risks and challenges that are associated with investing, and what you should look out for. We are joined today by Rachel Christian from the Penny Hoarders. For those who are new today, we are this virtual event series is co-sponsored by our United Way Suncoast and the USF Gus A. Stavros Center for Free Enterprise and Economic Education over at the USF College of Education. Our co-host Peter is unable to join us today. He did want to share some words though about the college and their commitment to supporting our Money Matters. The Center for Free Enterprise and Economic Education works to advance the effective teaching and integration of free enterprise, financial literacy, and economic education into the K-12 curriculum. Throughout its more than 40-year history, the Stavros Center has been providing resources in support of educators from across the Tampa Bay area. The center provides teacher training programs, curricula development efforts, and other strategies to ensure that free enterprise and consumer economic concepts reach students in today's classrooms. They are happy to partner with us to bring financial education to the Tampa Bay community, and we're proud to work with them on this Money Matters series. I'm now going to introduce Rachel, who I said is joining us from the Penny Hoarders. Rachel Christian is a senior staff writer at the Penny Hoarder. She's worked as a professional journalist since 2014, and her work has been featured in the Business Insider, the Osceola News Gazette, Evansville Business Magazine, the Mount Vernon Democrat, Evansville Courier and Press, the Winter Haven Sun, and more. She has written extensively about retirement, investing, life insurance, and other aspects of personal finance. In June 2021, she became a certified educator in personal finance with FinCert, a division of the Institute for Financial Literacy. She holds a bachelor's degree in journalism from the University of Southern Indiana. Welcome to Money Matters, Rachel.
Awesome. Thank you so much for having me.
We're glad to have you join us. Just a heads up for folks who are joining in on our program now, we have a couple links in the chat that you can use while we are chatting today about investing for beginners. The first link is a survey to complete before you leave today. It's for us to learn more about how we can improve this program and make sure that we are doing everything that to improve your knowledge on these important financial topics. The second one, we're actually at the very end of this going to be hosting a question and answer portion. So during our conversation today, if you have any questions for Rachel about investing, please click on that link and you can submit them, and we can make sure that we get those answered before our workshop ends today. So Rachel, we'll hop right into it and really getting into the nitty gritty about investing. Let's start with the basics and what a lot of people might be thinking out there. How much of their income should they be investing in? Where should they be investing? What should they invest? And then what kind of risks and should they be aware of?
Yeah, sure. So a little bit to unpack there, but probably one of the easiest ways for folks to start investing, especially if you're new to it, is to see if your company offers a 401k plan. A 401k plan is a specific type of investment account. It's only offered through your employer. Not all employers offer them, so that's why it's important to check. But what makes these a great vehicle for newbies, if you will, is that you can decide how much of your paycheck each week, each month, you want allocated to this account. It comes right out of your paycheck. So you never have to think about like, well, should I set this money aside? It happens automatically. There's usually you can invest in kind of broad-based things like mutual funds. You don't have to pick the individual stocks. Which makes things easier. And there's also a lot of tax benefits to it too. You can get a nice tax deduction, which, depending on the rest of your tax makeup can, boost your refund or, lower the amount of taxes that you owe, which is always a good thing, right? You can start small too. You could, just start by contributing 1% to 2%. The other great thing about 401ks is a lot of employers offer a match. And a lot of times you'll, hear this referred to as free money, which it basically is. Normally you have to chip in a certain amount, like let's say 3%, and then your employer may also contribute 3%. So, with relatively little effort, you can start investing. There are certain protections on it. The government doesn't want you to just, take this money in and out the way you would, let's say, a savings account. They really do want you to, earmark that for retirement. But for the average person, that's a great place to start. If your company doesn't offer a 401k, there is another option called an individual retirement account or an IRA. You can open it. It's very, very similar. The only difference is you open it yourself, and you can open them at a variety of different places. Different robo-advisors such as Wealthfront and Betterment offer them. There's also investment firms like Fidelity and Charles Schwab, and they come with a lot of the same tax perks. As far as how much to invest, it's, the golden rule is 20%, but for the average person, especially if you're just starting out, that sounds great, right? But the idea of just having 20% of your income lying around isn't always the most feasible thing, right? So that's why the common advice is just start with what you can, when you can, as early as possible, assuming that you already have like a nice little emergency fund of cash set aside, and that you have your credit card debt under control. Those should be your first two priorities before you start putting money away and investing.
Awesome. Thank you so much for elaborating more on that. So you talked about folks who might not have thousands of dollars to put down forward, opening up a bank an investment account, and so a lot of people are really looking at these more micro transaction apps like Acorns, Robinhood. Can you elaborate a little more on those apps? What how they differ from some like Wealthfront, and some things you might want to watch out for when you're using those apps?
Yeah, for sure. So Acorns and Stash, those are what are considered micro investing apps. So it's kind of nice because with Acorns, you have the option to round up purchases. You link a card, and let's say you spend, $4.25 on, Starbucks, even though Starbucks now costs way more than that. It would round it up to $5. That extra 75 cents will go into an investment account. You can also choose, let's say, for it to automatically withdraw $10 a week. So it's really easy. You tell them what your risk tolerance is, how long you plan to invest, and they pick the funds for you. You can check in every so often, see how you're doing, but it's really hands-off. They do charge a monthly fee. So if you don't have a lot of money in an account like Acorns or Stash, the fee can be relatively high. If you only have like $100 in there and they're charging you $3 a month, that kind of can add up after a while and kind of eat away at that. Apps like Robinhood, that's a self-directed account for the most part, even though now they are starting to offer a retirement account, but primarily you choose your own stocks. And so it's a little bit more hands-on. And the good thing about it is that it's free. They obviously there are some funds where there's like a slight expense ratio, but you're not paying a monthly subscription fee or something along those lines. So really, it just kind of depends on what kind of interface you're comfortable with, what your investing goals are. And then, just be mindful, no matter what platform you decide to use, what those fees will be.
Awesome. Thank you for, for sharing more. So, we've talked about some of the different apps out there, and they're becoming so popular now that people are just like diving into them, and for investing is just another form of gambling. Like there's a chance you could win big, there's also a chance you could lose a lot. So can you touch more on some of those some red flags that you should keep an eye out for, like things like the fees, when you're investing, we talked about 20% of your income, but if you're making paycheck to paycheck and you're looking at I want to try at least some, how do you go out balancing the inherent risks of investing with what you're able to afford?
Yeah, definitely. So when we talk about investing, a lot of times the things that kind of stick out to us are the more risky investments, right? Like stocks or even cryptocurrency. But the truth is there's a lot of safe investments out there that are earning a good amount of interest right now because interest rates are really high. That sucks for credit card debt, right? You don't want high interest, but what is good is there's lots of investments. For example, even high yield savings accounts right now at online banks are netting 4%. So you can just, let's say you only have a few $100s to start, you can put that money in there over time, especially with compounding. You can start to make some money. It's super safe, it's at a bank. And that's one option. Another option is certificates of deposit. Those tend to earn a little bit more than high yield savings account. And it's the same, the principle of it is you put a certain amount of money in, it's through a bank, and you have to kind of lock up your money for a certain amount of time, whether that's 6 months, a year, 3 years, but you're more or less guaranteed to get that percent of a return once that time is up. So for example, you could buy a 1-year CD at a 5% return. You know for sure after 1 year that you will get 5% plus your initial investment. So there's definitely a lot of options out there that are safer than stocks. And in general, you always want to diversify your portfolio, right? Stocks tend to have the greatest returns and the highest risk. So it's always good to balance that out with less risky investments that may not fetch as much of a return, but hey, your money's still growing. I don't know if that quite answered the question, but.
I think so. So you're talking about like diversifying your investment, people out there, they go on Reddit and they're like, oh, buy this specific stock, and, or they say, sell this stock. Do you think that, for most people, investing in a mutual fund might be a bit more beneficial than going at it with individual stocks where there could be more risk?
Yeah, definitely. Picking your own individual stocks, it requires a lot of homework, right? If you're going to do it correctly, you should be coming through earnings reports. You should be keeping up on, the company and the broader market and sector as a whole. For the average person, we don't have time for that, right? So there are, mutual funds, exchange traded funds, which are commonly abbreviated to ETFs, and index funds are basically all the same concept. They function slightly differently, but for all intents and purposes, the idea is that it's a collection of different stocks bundled together into one fund. And so in that way, it's kind of instant diversification. Instead of being like, well, I wonder if, let's say Walmart is going to be a winner in 6 months, you could get a consumer goods ETF, which tracks a bunch of different stores. Like maybe it tracks Costco and Walmart and BJ's and Aldi and, whatever, like 100 different stores all in one fund. So you can also get ETFs that track the overall stock market, like the S&P 500. So as the stock, I apologize, they're doing lawn work right outside my window. I apologize if there's a little bit of noise. But in that way, you can diversify your portfolio generally for less money. ETFs tend to cost a little bit less than mutual funds. They tend to have fewer fees. But of course, you always want to check what the fees are and the expense ratios. But you can find, very good, very low cost ETFs out there for, with expense ratios of 0.02%. So, you would be paying less than $2 for every $1,000 you have invested. So.
Okay. So when we're looking at, you touched on this, is like, it sounds like stocks, if you really want to get into it, it takes a lot of commitment, it requires a lot of knowledge in the day-to-day, checking in the market, and when I look at my 401k or I look at, my small amount of stocks that I have, sometimes it can be scary when you're looking at them and the economy's bad and it's going downhill. Over the last couple of years, it seems that there's been a lot of volatility in the stock market. So, the mantra of, riding your losses, sticking out for the long term, what advice can you give for folks who, might be dabbling, they have a couple $100s and they see that stocks are going down, they're worried about losing it, they want to withdraw fraud and take a loss? What, or they are, getting a lot of money and they want to take a win and, but take that cash out. What are your suggestions on folks who, see the market trends and they get worried about their stocks and, they either want to take them out or they want to put more in? Can you provide some more illumination on that and that anxiety?
Yeah, definitely. So it's really hard, right? You work hard for your money. The last thing you want to do is log into your account and see, oh, I'm at negative 20% or I'm at negative 15%. It can be a gut punch, right? That's why it's so important to kind of keep your eye on the prize. Remember what your goal is. Most of us should be, investing for the long term. We save for the short term, we invest for the long term. So if you know that you're investing, for retirement, stocks may be down for, a few days, a few months, even a year or two. But if you stay in the market, that's kind of the phrase, right? Time in the market versus timing the market. So the longer you can stay in, you can kind of ride those ups and downs. Where if you sell when you're down, that's called a realized loss. Money can go down in your account, but as long as you don't sell it, you haven't really experienced a loss yet. Once you cash it out, boom, okay, now you really are missing that money. If you see that negative balance in your account, you can just wait. The chances are, yeah, especially if it's tracking the overall stock market, it will go up over time. Now, if you are investing in individual stocks and you maybe thought this company, one certain company was going to, really take off and be on fire, and it turns out it just keeps going down and it doesn't look like there's any hope for recovery. Once you start dealing with individual stocks, it's really good to go into it with an investment objective. So to say, once I hit a 20% profit, I'm going to sell. Or once I go to negative 20%, I'm going to sell no matter what. That kind of takes the guesswork out of it, kind of takes the human element of like, oh no, what should I do? If you have a clear idea while you're going in of, when you're going to sell and when you're going to buy, that makes things easier. But if you're just investing for the long term and for retirement, one of the best things you can do sometimes during market volatility is just don't check your accounts, just kind of ride it out and remember that long-term goal.
Yeah, and that's a great point. And you talked about, like the larger funds versus, individual stocks. And I think it was either last year or the year before that when the GameStop mania happened. And, everyone was talking about GameStop and them doing the short sell. What are your thoughts on like these, as, social media has given a lot of leeway and leverage to like short selling individual stocks, they creating a lot of popularity around buying individual stocks. What kind of advice can you give for folks who might go online and they say, hey, everyone's purchasing GameStop or everyone's selling GameStop or any other kind of stock? What kind of caution should you give folks who see that and they're like, oh my gosh, I want to go and tap into my retirement fund and put some money into that, or I want to I have these needs, but I want to buy the stock and get in on this and see if I can make money out of it,
Yeah, definitely. Well, if you kind of think of it, by the time a lot of people online are talking about how great a stock is and how much money it's making, it's already made a lot of money. So by the time you buy into it, how much more earning potential does it really have? When you're looking to buy a stock, you want something with a lot of runway that has a lot of potential to go up. If something's already, moonshot up, the chances of it continuing to go and go and go are very slim. So, you can do your research, you can find out like, oh, maybe this particular one has a lot of potential, but the so-called meme stocks, Bed Bath & Beyond, GameStop, there's a few other ones, especially like right as the pandemic was starting. It was kind of a freak of nature thing, right? Like a lot of people piled in, they were short selling. A lot of people don't know what short selling is. General rule of thumb is if you don't understand something, it's probably not a good idea to invest in it. So if you don't understand why GameStop stock is just like experiencing exponential growth, it's probably not a good idea to invest in it. It's not to say that you can't do your own research and get opinions from other people online about what specific investments to do, but you also need to know that money that you put in, there's always a chance that you could lose it. And if you want to take less of a risk with your money, kind of those tried and true principles of investing for the long term, looking for mutual funds, index funds, ETFs, and responsibly investing with your retirement account are some of the safest ways to go about it.
Awesome. Thank you for providing that, because I know a lot of people can get wrapped up and swept up in those popular, investment opportunities. So as a word for everyone, before we get into our last topic, before the Q&A, if you have any questions or you've heard something and you're like, hey, I want this clarified, or can you elaborate on this? Please use the link in the chat. We found out that the links were not visible before, so they have been reposted. The first link will take you to our Q&A form, so please complete that if you have any questions or comments or any concerns. And in the meantime, we'll move on to our final major topic before we jump into the Q&A, and that's on the topic of cryptocurrency, which has become a huge thing over the past couple of years. It's even more volatile than regular investing. So, for folks who might not know what cryptocurrency is, can you provide more information on generally, what it is and how it's different than regular investing?
Yeah, sure. So cryptocurrency is, digital assets, digital currency. It started in 2008 with Bitcoin, which is kind of considered the granddaddy of all cryptocurrencies, right? Over the past 3 to 5 years, there's been an absolute explosion of different cryptocurrencies. There's literally hundreds of them now. Anybody can make one. The same rules don't apply for starting up a cryptocurrency as, let's say, creating a company that gets listed on the New York Stock Exchange. So there's definitely a lot of bad actors out there. There's a lot of just straight out scams. Generally, financial advisors who it's a very hotly debated topic among financial advisors. A lot of them believe that you shouldn't invest in them at all. Generally, if you are very interested in cryptocurrency and you've done a lot of research in it, you still should not allocate more than 5% of your total portfolio, not 5% of your income, but 5% of your portfolio. And that's because it's a highly speculative asset. There's not kind of the same metrics of being like, oh, well, this company performed really well. Its stock will go up. Cryptocurrency is kind of its own animal, right? And we have seen huge losses in the cryptocurrency market over the last more than a year now. They're calling it a crypto winter. Maybe springtime will come, maybe it won't. It's very up in the air. So yeah, it's definitely one of the riskiest assets that you can invest in. Generally, the two more stable, I guess you would want to say, coins are Bitcoin and Ethereum. Those tend to be the two most stable. Gosh, I so apologize again for this lawn work going on outside. But yeah, in a nutshell, for beginners, it's just generally safer to stay away from cryptocurrency. If you are highly curious about it, you can put a little bit of money in just kind of as a fun thing to see where it goes. But yeah, as always, never invest more than you're willing to lose.
Awesome. Thank you so much for, providing some more information on cryptocurrency. Because I know personally, I've looked at, I've had friends that talk about getting like Dogecoin and stuff. I don't understand fully everything. So it's cool. It's better to like watch for me than to actually like delve into that myself. So thank you so much. We're going to wrap up that main portion of our workshop and move now on to our question and answer. So as I said, we'll keep the Q&A form up through the end of this portion. So if you have any questions that are coming in, please, we will have some time to answer them. Also, as a reminder, we will have a post-workshop survey that we're asking everyone to complete. That link is also already provided in the chat. So before you head out today, whether it's at the end of the meeting or it's early, please make sure you complete that so we can learn more about how to provide better information for you. So we'll jump into our questions right now. This one is very recent, within the past couple days, and it's about Silicon Valley Bank. So the closing of SVB last weekend has a lot of people uneasy about investing and even putting money into investment savings accounts. Can you talk a bit about the protections that are in place if you contribute to a high yield savings account or CD?
Okay, so yeah, just so I make sure I understand it, it's saying like what the collapse of Silicon Valley Bank may have on other banks?
Yeah, so this is I think it's that, and then also like if you decide to invest into like a high yield savings account or or a CD, what kind of protections are, either through the
Okay.
FDIC or other agencies to make sure that your money's kept safe.
Yeah, definitely. So anytime you open a savings account, you open a high yield savings account, CD, etc. One, you want to make sure the bank or the financial institution is FDIC insured. This will be pretty easy to find on its website. You can also check, but what FDIC insurance does is it insures up to $250,000 of deposits at each financial institution. So, if you are one of those lucky folks who has more than $250,000 sitting around in cash, you can spread it around to different financial institutions and you would get 250,000 at each one of them. What is good about this is if the bank folds, if it goes under, and this has happened before, then you have recourse with the Federal Deposit Insurance Commission Corporation, that you can get that money back, up to $250,000. So that's also why fixed income investments like CDs are considered safer than stocks, is because you have that recourse with the federal government. And that recourse was put in during the Great Depression when we saw that huge run on banks. So many people lost their life savings, and the government stepped in and said, no, we're going to start, putting insurance for the average American up to a certain amount so that people trust banks again. So that's kind of the protections you have.
Awesome. Some other questions. So we had throughout our conversation where you kind of touch on some of these. So that might be a reiteration for folks who already joined or for folks who joined late, this will be new information. So for folks that, spend a large amount of their income on fixed expenses, rent, car payments, groceries, should they wait to invest or until they have more of a discretionary amount of spending, or should they, put a small portion aside right now?
Yeah, so that's the kind of tough catch-22, right? You want to start investing as soon as you can, but it's not always financially feasible, right? If 30% or more of your income is going towards rent and you have credit card debt and you don't have an emergency fund, okay, well then it's not a great idea to start investing right now. Your two biggest financial priorities should be creating a cash emergency fund, at least with 2 months worth of living expenses saved. Some people say you should have, a year's worth. Okay, that would be great in an ideal world, but at least 2 months so that, if you lose your job, if your car breaks down, you don't have to put all of it on a credit card. You have that cash there. The second thing is you want to, pay down your credit card debt as much as possible. Maybe it's not completely paid off, but it's definitely the light is at the end of the tunnel, especially with interest rates being so high. Once you have those two things under your belt, then, feel free to start investing. I was kind of caught in this situation as like a personal anecdote when I was a reporter. I was making about $12 an hour. And I did not have the extra money, really at my disposal to start investing. I didn't start investing until I was 26, 27, because right out of college, I had to pay off credit card debt. I had to build up my emergency fund. So just look at your own personal situation. It can be hard sometimes because you see you should invest 20% or whatever, but just look at your own personal situation. Start small, start early, but definitely get that emergency fund and debt under control first.
Awesome. I completely agree. It's so important to focus on the necessities before you start, doing something that, is no different than if you went to the casino or something, and, wanted to do some, risk and reward stuff. We had another question just come up on the tax implication. So for individuals who want to start investing in the stock market with either day trading or long-term investments, can you talk more about, the tax implications on, capital gains, losses, all that kind of fun stuff?
Yeah, definitely. I don't think many people refer to taxes as fun, but I appreciate the enthusiasm. So When it comes to investing in taxes, it depends. If you're investing in a retirement account, it can actually be quite beneficial. You can get a tax deduction. It lowers your overall taxable income. So in the eyes of the IRS, it looks like you make less money. That can be good. So that's why investing in 401ks and IRAs can be so advantageous. The other good thing is you can sell investments within a 401k or an IRA, and you don't get a tax bite until you take that money out later, which is also nice. There's also different retirement accounts called Roth IRAs or Roth 401ks. Those are a bit different, but those also have beneficial tax treatment. If you are investing in a taxable brokerage account, for example, with Robinhood, or just a regular taxable account at Fidelity or Charles Schwab or something along those lines, generally the rule of thumb with capital gains is if you own a asset for less than 1 year, you tend to pay a higher capital gains tax rate. And that's to kind of, the history of it is to kind of discourage people from day trading, right? If you wait longer than a year, you tend to have a lower capital gains tax rate. So if you're not investing in a retirement account, it's generally more advantageous tax-wise to wait at least a year before you sell a stock.
Thank you so much and so you had talked about this a couple of times about like the retirement accounts. I do some tax assistance, tax preparing assistance through my job at United Way Suncoast, and we have folks that come in sometimes that have withdrawn from their retirement accounts early and might get dinged with taxes. Can you talk more about the limitations on that? The time, what age you can finally withdraw funds without being taxed? Can you share more information on that?
Yeah, and thank you for bringing that up. It's a really good point for folks to know. A lot of times we hear about how great 401ks are and things like that, but there are restrictions to them. Like I said earlier, the government doesn't want you, taking money in and out the way you would from a regular savings account. So what they do is if you take out money before you're 59 and a half, very specific, you will face a 10% penalty from the IRS. So whatever money you think you're withdrawing, you're going to have to pay 10% on that. To the government. And if you don't, there's a lot of implications on it. There are some exceptions. There's a few hardship exemptions, things like that. You can take out a certain amount of money from your retirement account to, put down a mortgage for a home, and in different emergency situations, such as if there's like a natural disaster, things like that, you won't get a penalty. And that's always really, really good to look up to see, because a lot of times each year they'll kind of change it or they'll modify what those exemptions are. But yeah, generally you will get a 10% penalty, from the IRS for withdrawing early.
Awesome. Thank you. Sometimes, the tax code can be so complicated sometimes. So I think it's important for folks to know more about that specific one if they're looking at investing opportunities. So as, we become a more like socially conscious society, folks want to do be more, socially responsible with their investing opportunities. Do you have any recommendations where folks can learn more about how to be more socially responsible with their investing? And can you maybe elaborate more on what that might mean?
Yeah, sure. So we've seen a big trend over the past few years about socially responsible investing. There's also, it's called ESG, environmental, social governance. And these are basically corporations, companies where they have prioritized whether it's being more eco-friendly or having, better practices as far as, the way they treat their employees or things of that nature. There's been a lot of funds, mutual funds or ETFs that kind of try to bundle these, more socially progressive or environmentally progressive companies together. You really have to kind of dig into the performance of these companies. And kind of decide, are you investing with your heart or your wallet? Sometimes you can find that sweet spot where you find a fund where it offers really good returns and it kind of meets, your morals and values. But at the same time, there's also funds out there that have kind of capitalized on it. So they tend to charge higher fees and commissions, and maybe the performance isn't as good. There's a lot of different, if you go with a robo-advisor, such as, Betterment or Wealthfront, they already have kind of pre-made portfolios and you can dig into those. That makes it a lot easier than trying to like build your own, socially responsible portfolio from scratch. If you're trying to learn more information about them in general, going and reading a lot of the different publications that are out there. I was just reading one this morning from the Harvard Business Review that has some really good pointers as far as how to get more information or kind of know what to pick. But in general, just kind of pick an issue that's really important to you. And stick with that, find companies that align with that, whether that's, lowering admissions or, things of that nature, whatever it may be, women-led companies. And because every company is not going to hit all the check marks. So finding out what's most important to you and what you value most in a company will kind of make those decisions a little bit easier.
Awesome, thank you. We had another question come up on, I'm not sure if you'll know the answer to this, on if you inherit stocks, from a partner, a spouse, a parent, grandparent, how does that affect your taxes if you inherit these stocks from other people? Do you know?
Yeah, so it depends. If you inherit, let's say, a 401k or an IRA, especially if you inherit an IRA, it can have a lot of advantages, depending on who you received it from, whether it was your spouse or whether it was your parent. Those generally tend to have pretty good, implications. You can kind of hold off from having to cash that in so that the money can grow for a certain amount of time. After a while, you do have to start making required minimum distributions from those type of accounts, and you will have to pay taxes on them. It really depends on what type of an account it is. And those questions, anytime you inherit a certain amount of money, like basically anything over a couple $1,000s, you really should sit down with a financial advisor and get some expertise and some insight on that, because there are a lot of different tax rules around it. And the last thing you want to do after you inherit something from, a loved one is to, see some of that money get eaten up in taxes and fees. So an expert can really kind of help guide you as far as what your options are so that you can make the best decision for yourself.
Awesome. And I think that advice applies to, everything we're sharing today. Folks, and this is the thing that we want to stress with all of our workshops is, Rachel and United Way and USF, we are not your financial advisors. So, I don't want anyone coming from this workshop saying, I'm going to go and send all my money on investments, or I'm going to do X with this. If you have questions, please make sure that you consult experts on this. We are here to provide just general information. So that's, inheritance or any other kind of issue we're talking about today or at a future workshop. And on that note, so someone asked, we had talked about the importance of paying off debt early, and also simultaneously the importance of investing early. We had someone who says they're still paying off their student loans. What is a bigger priority for them, paying off their loans in full, or on early, or starting early on investing?
Yeah, so that's a huge debate, right? In the finance world, you have a certain camp that says you should pay off all your debt, including your student loans, before you ever start investing. At the same time, that would be ideal. But if you have 20, 30,000, more in student loans, it may be a while before you pay that all down. You may be in your 40s. And then at that point, okay, you have no debt, but also at the same time, you have no money set aside for retirement. And retirement is much, much closer at that point. So generally, if you have student loans, and most public federal student loans fall into this category with a low interest rate, that's generally seen, or let's say you're in a income-driven repayment plan where you don't have super high monthly payments. It's, something more manageable. It's always a good idea, if you can, to start investing small, either in that, workplace retirement account, setting aside, even if it's just 1%, 2%, 3% of your income, to start investing as young as you can. And that's because over time, that money will compound. The earlier you start, somebody who starts at 25 or 35 is going to have a big advantage as far as the amount of money they've been able to accumulate through investing than somebody who starts at 45 or even 55. So as long as you don't have a huge monthly student loan payment and your interest rate isn't really high, you can definitely make the argument that it's wise to do both. You never want to neglect paying back your student loans. You never want to go into default. But at the same time, as long as you can stay current with those payments, setting a little bit of money aside for investing, it's always a good idea.
Awesome. Yeah, that does sound like a great idea. So we have a couple more questions left. And if anyone wants to use the form in the comments to ask any last minute questions, you're more than welcome. We're gonna now move into sorry, I lost it. Somebody is asking about having a diversified portfolio, and this is something that we touched on earlier on. If they're looking at, some of the Wealthfront and other apps that you talked about, they kind of give you pre-selected things that you can kind of move around and everything. What percentage of this person's investments that you recommend or is generally recommended should they put towards stocks versus bonds? Things that are going to be a bit more stable long term versus things that are going to be a bit more volatile.
Yeah, so a lot of times there is a rule in investing that you tend to want to take more risks when you're younger, right? Because you have more time to bounce back from potential losses. So a lot of times they recommend having, financial advisors recommend having a heavier stock allocation when you're younger. As you move closer to retirement, you kind of want to, favor more bonds and safe assets like CDs, cash assets, because you're going to need that cash a lot sooner. You don't need to tap your investments for retirement when you're 35, but when you're 55, okay, well, retirement may be, 10, 15 years away. So if you have a high risk tolerance and you're young, you could go as high as 80% stocks, 20% bonds. As you get closer to retirement, you really kind of want to see that flip more. So that, let's say 60 to 80% is in bonds. Though a lot of people do argue you still want to stay, have a certain percentage in stocks because those still can, you can experience a lot of growth. But you're mostly like want to protect yourself against risk. So if you're going to retire in a year or two, you don't want all your huge nest egg that you've worked your whole life for, but it's still in the stocks to suddenly crash like we saw during the recession or even right around, when the pandemic began, right when you need that money, right? So that's why you kind of want to start transferring your stocks over to bonds, CDs, even a high yield savings account once, retirement is 10 years, 15 years or less away.
Someone asked, something that we've covered throughout today, but this would be a good maybe time at the end of this, to reemphasize, what are some major investing red flags? When folks are going out there, they're looking at, hey, I have some, cash in my budget to spare for investing, or, looking at a retirement account, what are some things that they should be cautious or aware about when they're navigating all of the different options out there?
Yeah, definitely. Do your homework, do your research. If you are putting your money into a bank, make sure it's FDIC insured. And the same goes for any bank type investments such as CDs. If you are investing, make sure the company is reputable. Do some research on the company itself. Has it been around for a few years? What's its digital footprint? So basically, like, can you find a lot of information about it when you give it a Google? If you're looking for to pick individual stocks and things like that, look at the company's history, look at its earnings reports, see if it has a good track record, if it's been in the space, how does it stack up compared to other competitors in that same area, what's its, earning potential, even though nobody can predict the future, does it have a good positive outcome? or has it experienced a lot of turnover in leadership? Is it potentially going to file for bankruptcy? Has it been implicated in, in a fraud case or anything to do with any kind of illegal activity? That's probably one of the biggest red flags. If a company or, an investment firm or anything like that is in any way even associated with anything illegal, absolutely, stick clear of it. After that point, just kind of using common sense, doing your research, and then finding a trusted financial advisor, somebody who's a fiduciary. That's a really important word to look for when you're trying to find somebody who's offering money advice. They are, ethically obligated to put your interests first. So they're always a good person to ask if you have specific money questions or investment questions.
And that's a great segue into our second to last question. Someone asked about how they should, if they don't want to go the app route, they don't want to, and, but they're interested in maybe picking their own stocks or, getting some assistance, if they're looking at somebody to help them with their stocks, a financial planner, a fiduciary, what are some recommendations for vetting them, to make sure that that's going to be the best person for them and their own needs?
Yeah, definitely. So you want to look for somebody who is a fiduciary. A certified financial planner is one of the best designations. I would say they have to go and complete a lot of coursework, a lot of ethics training. And basically what a fiduciary means is they don't earn a commission by suggesting things or giving you advice. It's not like, let's say, an insurance agent who maybe will say, oh, well, you should really, buy this policy or invest in this or whatever. And really on the back end, they're getting a certain percentage of it. So it may not be in your best interest, but hey, it's good for their bottom line. A fiduciary, they will, look at your financial plan and they'll say, okay, this is what we recommend, or this is what I believe, my personal opinion is the best for you. As far as other things to look for, make sure that they have a reputable looking website, that they have reviews, that they, and it's not just a recommendation from one person. If your friend tells you they know a guy and he's great, find this guy on at least two, or gal, on at least 2 or 3 other places. Don't just take one person's word that somebody is a be all know all source of information when it comes to finances. If you can get that verified by other sources and hey, this person looks great, most places, most financial advisors will give you a free consultation, even if it's just 15 minutes. Definitely take that time and take advantage of that before you sign up for, an hourly rate or an expensive financial plan, to kind of gauge, like, what are your rates? What can you offer me? What's beyond your, areas of expertise? And here's a little bit about what I'm looking for. And hopefully all of that will, land you somebody who can really help you along your financial journey.
Awesome. So as we get to the last question, I want to reiterate that we have a survey in our the comments right now. It says, please complete this brief post-event survey here. We ask everyone to complete this. It's a couple questions just to make sure that what we're doing is successful and that we're providing good quality content that you're looking for. So I highly encourage you, please, before you leave today, that you complete that. And as you're completing that, we have just one final question to kind of wrap everything up. So you've given some amazing information today, Rachel. We are so appreciative. If folks are inspired after this to learn more or to get more information, do you have any recommendations or suggestions on how to find equally good quality information online?
Yeah, sure. So I'm a big fan of government and educational websites. Investor.gov has some great explainer articles. If you're curious, what is the difference between a mutual fund and an ETF? They have lots of articles on that. The Securities and Exchange Commission website likewise has a lot of information about stocks and equities and things like that. The Penny Hoarder, shameless plug right now. We have a lot of information, especially for, people just starting out. about investing, and then, broader personal finance topics such as how to build credit, how to pay down debt. And then, yeah, just kind of those institutional kind of legacy journalism outlets like Forbes, the Wall Street Journal, great sources of information, both of current events and, just to help build your foundational knowledge.
Well, Rachel, once again, thank you so much for all of your expertise you're able to share today. I hope folks are able to come away from some solid information if they're ever looking at investing or enhance the current investments they already have. Thank you so much for your time today.
Yeah, definitely. Thank you so much for having me.
Okay. And for folks who are interested in joining us along on our Money Matters journey, we'll be hosting our next workshop Monday, April 10th from 12 o'clock to 1 p.m. Same time, same place, and we'll be focusing on the topic of credit scores. And what about them, what goes into them, how to improve your credit score, all that fun stuff. We hope that you can join us next time. Once again, thank you for joining us today as we explore investing for beginners, and I hope you have a great rest of your day.